Do you broadly think that this will be taken in stride as a good thing for markets and that it should be?
I think absolutely. Certainly major banks are assuming there's going to be deal. The kind of people who advise major banks assume there's going to be deal. So if there was not going to be a deal, I think we would already be seeing it. As Eamon, I like Eamon's phrase, squirrely moments. We haven't seen those squirrely moments. The people who you would kind of expect to be bad-mouthing this deal are. So that's not shocking. And again, I think, if everything goes smoothly at this Rules Committee meeting later, again, a very positive sign that really supports the kind of confidence you're seeing on Wall Street right now.
Jimmy, why is it, and I've pointed this out before, but so a decade ago when we had the really bad debt ceiling fight, we had half the debt to GDP that we currently have. Interest rates were way lower. I mean, why were we so obsessed with it back then? And suddenly this time around, it's like, no big deal.
Well, I think, right. I think broadly people are thinking about the debt a little bit differently. It doesn't that the fact that we've had much higher debt to GDP ratios, but yet we still had low interest rates. I think has helped support the idea that perhaps we have a greater sort of runway on our debt than we thought previously. Listen, the economy after the pandemic, we expected the debt to go up. That has happened, and I think just among voters, there just isn't the sort of concern that we saw previously, whether that's right or wrong.
Yeah. So, Evan, I thought you also made the point kind of pushing back against some of the narratives going around that, okay, a deal isn't necessarily going to be a bad thing. People have been concerned, okay, this is going to trigger more because, again, people who want to put their money in government money market funds have been waiting for this to happen. So the idea is, okay, we're going to start to drain reserves out of the banking system again or deposits. Why do you think that concern is overblown?
Yeah, this idea that liquidity is going to be drained from the system is, we certainly think is overblown for a few reasons. So first, there's plenty of reserves in the banking system. So even though you're going to see some decline in reserves, the overall level is fine. Second, Janet Yellen is no rookie with this stuff. She understands that the way the financial system works, and she's not going to issue tons of T-bills into the market without having an idea of financial market functioning. And then finally, there's just not that strong a causal link between the reserves in the system and what happens to risk assets. Banks don't need as many reserves to drive buying stocks or lending out to consumers or businesses.
So do you think that the system is going to be, at all tested in the next coming months, or do you think that that whole experience is largely behind us?
I think we'll see some draining of liquidity, but it's not going to be this major thing that a lot of people are calling for. Another point is that so much of the liquidity is from money market funds who are invested in the Fed's overnight repo facility. So it's just money coming out of there and into bills. So the actual decline in reserves on the banking system just won't be that much. So I think a lot of this is overblown.
So let me then kind of close with a quick comment from each of you on the outlook for the months to come. Jimmy, it's kind of widely assumed that based on leading indicators and the rest of it, we're going to tip into a recession at some point, maybe in 3 to 6 months' time. I don't know exactly when. What would you say about that assumption based on the way markets are trading and the fact that we seem to keep climbing this wall of worry and, coming out the other side?
Yeah. Oh, yeah. It really is sort of a classic situation where you're climbing a wall of worry right into a downturn. Listen, I think the case for a downturn remains intact. You could even make the case the longer it takes to happen, the more severe it will be. But I think those financial indicators and stressors are there, and I that would still be my expectation.
That the financial stress is meaning that we're going to still have this broader downturn. Yes. And to be sure, I think things are fragile enough that if there was a last, because the expectations are we're going to get a deal, no deal. I mean, I think that's the kind of shock we absolutely don't need right now. Right, Evan. Though, are there other shocks that you're worried about, and what do you think about the business cycle at this point?
Yeah, look, I mean, the Fed will keep tightening. That looks quite likely now that we're past this debt ceiling deal. But they're tightening in large part because growth is fine, right? Yes, we see some leading indicators weakening, but we also see the housing market looking like it's bottoming. We're also seeing some of the internals of ISM manufacturing also inflect higher. So as much as these leading indicators have been decelerating, that's been happening for a long time, and now we're actually seeing some tentative green shoots. So overall, we think it's a decent environment over the next few months for the market.
Do you think the labor market just stays, doing what it's doing? Or it was interesting, even in the Conference Board index this morning, the household assessment of labor markets had dropped substantially. So it seems like households are telling us something.
If we could look at only one print, it would probably be initial jobless claims and then also continuing jobless claims. And initial jobless claims, after rising for a little bit, have really stabilized over the last couple of months. Continuing jobless claims are coming down. So, we should expect some labor market softening, and that's what we're seeing when you look at payrolls. But it's so slow. It's such a slow slowdown in the economy that there's just no indication that we're going to fall off a cliff.